Hello, I'm Frank Timons, founder and CEO of Pier 8 Investment Partners. Thank you for joining and listening in today. We wanted to take some time to look back at 2020 and look at the performance, and then kind of discuss how we're positioned today for the portfolio moving forward. When I started this company 7 years ago, it was really on a very elegant thesis. Namely, if you just focus on buying the small cap disruptive innovation companies, over time, you would do well from an investment perspective. These companies would continue to innovate, they'd grow market share, and Wall Street would understand that these companies up over time, or better yet, if Wall Street was too short term, which sometimes happens, the big corporates who understood their core industry would look at those innovation companies as strategic bets they had to make. We've been very fortunate since we started this firm 7 years ago that we've correctly identified 40 companies that got acquired by larger corporates or by private equity. And I think this is a theme of innovation that you continue to see over the next several years. 2020 was a very tough year personally for a lot of folks. The shutdown of the great pandemic, school closing, etc., really challenging. Paradoxically, it was actually a pretty decent year from a risk asset perspective. Markets sold off in the first quarter and then rebounded sharply after federal and government intervention. Pier 8 Investment Partners had a very strong year, and I'm happy to report that all of our products substantially performed their respective benchmarks. Our long-only version of Lake Geneva actually outperformed the S&P, the NASDAQ, and the Russell Small Cap Growth Index. Very, very strong. And our hedged version outperformed the relevant hedge fund industry benchmarks. So what drove this performance? If we kind of peel back the onion, really being in the right companies, in the right neighborhoods. From a portfolio perspective, we had very strong stock selection, and we also had very good risk management. And if I kind of walk through the year, I look at the neighborhoods we've been invested in for years that really, really helped. If I can pinpoint one or two things, the typical company we own, it's all about business agility. Our consumer discretionary companies could pivot on a dime to change to meet demand. People change their offerings, they change their payment terms, they met the customer where the customer needed to be. Many of you know Pier 8 for our long history in technology investing, and I appreciate that given our venture capital background and corporate development background. But when I look across the strategy, last year we did very well in about a half a dozen sectors. And our top performers last year were actually consumer discretionary and our healthcare needs. And why was that? It was interesting to see, we definitely saw COVID-19 have a demand shift where consumers were getting things online. And we had companies being able to start up and address new markets, for instance, for face masks that we never saw. On the healthcare side, we had companies that benefited from next generation testing to allow for COVID-19 testing, or the rise of telemedicine, a theme we've been invested for years. On the educational side, as the big colleges sent students home, we had education companies be able to step up and address those needs. On the industrial side, we had fleet management companies able to pivot in a dime when they really started to see backed up in the supply chain. Remember, we couldn't get cleaning supplies or toilet papers in the stores. It's because of distribution systems. And we had companies that were able to pivot very quickly using data and move very business from an agile perspective. Our companies invested in technology in the back end so they could be leaning forward and actually delivering to where demand was. We have an industry insurance brokerage company we own. They have a very strong technology back end, and they did very well last year, able to far outpace the typical insurance company because they have a different business model, an innovative business model, and they offer solutions that allow the traditional independent broker to spend less time on back office functions, more time on selling. So very strong year across sectors. Most of our companies delivered expectations on the short term, far exceeding Wall Street expectations. And we're very bullish on the outlook moving forward as these companies continue to get strength, get bigger, and get their brands out there. Some of you may be asking, well, did we miss it? You had a great year in 2020. Did we miss it? And it's a fair question to ask. A lot of investors think about valuation and they think about, well, the market's up a lot, especially for a lot of innovative companies. We think the answer is resounding no. Our companies, we look at the lens of market cap for addressable market, and these companies trade at a fraction of their total addressable market. If you look over the next 2 to 3 to 5 years, they're going to be growing multiples faster than the S&P or the NASDAQ. And then it's something really interesting to look at the traditional underperformance of small cap over the last 5 years relative to the mega cap. It's been well reported about people who are all on Facebook and Apple and Microsoft and the Googles of the world. And those companies are trillion-dollar companies now. In fact, the incremental market cap for those companies is combined $1.5 trillion over 4 years. If you were to contrast that to the market cap of all the small tech companies in the small cap Russell 2000, that market cap combined is $300 billion. So you just see the orders of magnitude and opportunity set. These mega caps are flush with cash. Wall Street's expecting them to deliver, and they're going to have to deliver on growth. And most of it is not going to be organic. They're going to be looking for those strategic companies to make them stronger. The strong will get stronger as they buy our companies. In addition, the marginal larger cap company that maybe is not as strong fundamentally, but has access to debt and capital, they're going to do acquisitions to pivot. Think of IBM, for instance, when they bought Red Hat. Definitely a pivot to change their business model. The other thing that's really interesting this time is the rise of private equity. The reports that there may be $4 trillion of dry powder out there in private equity coffers. Last year alone, the well-known tech-focused private equity companies raised another $100 billion. They're going to be looking at our assets. So we step back and look at our portfolio and how we're thinking about 2021. We are taking advantage of short-term volatility, of market rotations, to continue to build positions in those names where we see a competitive advantage in the short run, where these companies will continue to innovate, move quickly, take market share, and come on the radar screens of the bigger cap companies. Thank you for all your time and listening. We appreciate your feedback and support. Good luck in 2021.